Everybody, it's Sue here. Welcome to our first LoveBiz development session of 2025. And it's lovely to have a dozen ladies in the room with us today. And we've got Rebecca joining us as our expert, and she's going to help us from being bamboozled to business savvy. And we all know in business, we need to know our numbers and we need to have great advice and support from an accountant. But Rebecca's doing a bit more than that these days. Rebecca, would you like to introduce yourself?
I would. Thank you. So I had a conversation with Julie several months ago about the new project that I've started, which is called Love Your Numbers. And she said that she thought I'd be great at doing the training and development session and put me in touch with Sue. And that's how I ended up doing this session. And January probably wasn't the best month for me doing this because I'm still trying to do loads of tax returns. But here we are. So yes, I'm an accountant, obviously, and I've been in business for 13 years, working with small businesses. And more and more, I'm coming across people that say, a bit like Tina was saying, that they're scared of the numbers and therefore just bury their head in the sand and just ignore it. And actually, I want to empower people, business owners to understand their accounts and what they mean, because obviously then that means, one, you can make more money, and we all want to do that because nobody goes into business to make a loss. And actually, there's a huge amount of small businesses that don't make any money. So I want to help people do make money and make more of it. So yes.
Thank you, Rebecca. Thank you. So, ladies watching on replay, ladies in the room, are we ready to be business savvy?
Yes.
Yeah? Okay. Rebecca, do you want to share your screen? And I'm going to mute myself. So it's over to you now. And please do, make some notes if you want to. Add some questions as we go along in the chat box if you want to. We'll answer them at the end. And you'll be able to watch this on replay as well in the next couple of days. So here we go. Thank you, Rebecca. Over to you.
Thank you. Right. So a bit about what we're going to cover today. We're going to go through a bit about the basics on what a profit and loss statement is and what balance sheet is. And we're going to talk about some metrics of what you can, the numbers that you can use in your business, and a bit more about making sense of your accounts. And then we can do some questions and answers at the end. So if you've got any questions, maybe make a note of them. We can go through them later on. I don't do technical where you've got so the numbers that you can use and what you can do with those, and a bit more about making sense of your accounts and how you can use the information to help your business. And then any questions and answers at the end. So if you've got any questions, maybe make a note of them, and then we can go through those at the end. And I don't use technical jargon, so hopefully everything should be easy for you to understand. But if there is anything, then maybe just give me a wave or something, or maybe somebody can shout out, and I will cover it at that point in time, because otherwise, if you get to the end, it might not be as relevant. So I've already talked a little bit about me. I've been in practice for 13 years and helping small businesses. And I've started Love Your Numbers as a project to help small business owners turn their passion into profit, because none of us set up in business because we want to make a loss. So I want to help small business owners feel more confident. So what is a profit and loss statement? So if you use software, then you may have come across a profit and loss report. They'll pretty much all look fairly similar. Usually you'll see them showing a comparison that might be year on year, month on month, might even be quarter by quarter. And obviously you can do it as many different as you like. So it could be going back 6 years. But generally, if you're looking at a published set of accounts, you would normally see 1 year compared against the previous year. I will go into the categories in a bit more detail, but obviously at the top you start with your income, and then you have cost of sales, which tends to be, although it's called cost of sales, obviously it also means cost of sales and services. So if you provide a service and you've got costs of producing those services, this is where your costs would be. And traditionally you'll see things like, if you were a retail business, you would have things like stock in here. If you're a manufacturing business, you would have things like the materials that you've bought in, all those sorts of things will go into cost of sales. So anything that is kind of helping you have a product or something to sell, that all those costs would be in there. And then under that, we have all your admin costs. They're all your overheads, all the sorts of things that you would have, whether you've actually sold anything or not. So whether you've got salaries, rent, bank fees, all those kind of random things go in there. And at the bottom, obviously, you then have operating profit. It obviously vary depending on whether you're a sole trader or a limited company. If you're a sole trader, you probably wouldn't see tax on this statement. So at the bottom, it will say your profit and your profit after tax will be the same figure. If you're a limited company, generally throughout the year, obviously your corporation tax wouldn't be in there because it's a one-off figure at the year end. But otherwise, generally in the set of published accounts, then you would have profit corporation tax in there as well, and your bottom figure would be slightly different from the one above. So what is a profit and loss? It's a tool to assess your financial health. It shows your income and expenses over a period, as I talked about before. It doesn't have to be, it can be whatever period you like. So generally it will be something easy like a month or a year or maybe a quarter. You can do year to date. You can do, if you've got, for some reason, some businesses obviously have different reporting timetable to maybe a normal calendar month. So you can do, I don't know, the 21st of one month to the 20th of the next. So whatever works for you, but generally you will find it comes to the end of a calendar month or calendar year because it's obviously easier that way, and traditionally obviously software will usually work on that way as well. That helps you understand if you're making a profit and loss, hence the name, obviously profit and loss, and it's not cash. And we're not going to go into the differences between cash and accrual accounting because that can be quite complex, but but a profit and loss is, so if you were sending out invoices, then your sales would include all that amount that you've invoiced, whether you've been paid for it or not. So there is a difference between kind of cash and what's in your P&L. So the profit and loss statement will show your turnover minus your expenses, which then equals your profit. So and obviously over a specified period of time, it's the same. And it's, why do we have a profit and loss? Because actually it tells you whether you are making money. It can help you identify things like whether your pricing is right, whether you need to identify changes in expenses. So when you're looking at a comparison, you can see where changes have happened. So if you've got a year on year, you can see where your profits, your sales has increased. You can also compare the expenses, so you can see where your expenses have increased, and things like salaries, you can see whether your salary costs have increased and what it's really easy to identify kind of the differences in your accounts to see what's changed and whether your profits increased or decreased, and helps you also identify actually whether you're expecting to find those differences. So if your salaries have gone up but actually you're not sure why, it can help you actually identify where you need to maybe do a bit more research and find out what's happened in your account. So this is a bit more detail about what you find in your profit and loss statement. So as we talked about at the beginning, generally at the beginning you'll have your turnover, so that can be anything from your the money that you received in for the services that you've sold, for the goods that you've sold. If you have interest on a bank account, then that would go up the top. If you've received any grants, if you're a not-for-profit organisation as well, donations and funding would also go up in turnover. Any sort of income that's coming in. Cost of sales is your cost of providing services and goods, so everything from buying products in to then sell. If you're creating products, everything that you're buying in, the raw materials, and any cost you have of making those. So if you've got wages for staff for creating those products, then all that sort of stuff would go in your cost of sales. And that gives you a gross profit. So your turnover less your cost of sales, it gives you a gross profit. So your gross profit is everything before you then take out your overheads. Overheads will be everything from everything else. So you've got your sales, you've got your marketing, you've got IT costs, telephone, rent, rates, utilities, salaries for directors. I think what else is in there? Depreciation, that we won't go into too much detail about depreciation. So everything, once you've taken all those costs out, you then have your operating profit, also known as net profit, which is your kind of your profit from your business. And also the difference between, for a sole trader and a limited company, a sole trader would have won't have any wages costs for the owner of the business in a sole trader set of accounts. So your profit from the business, that's effectively all wages. Whereas with a limited company, if a director's usually will be taking a low salary and higher dividends, so part of their salary will have come out of, will be part of the overhead. So that profit will be either what you can then take out of the business as your dividends after you've accounted for the tax, but that won't include what you're taking out as a dividend. And then for a limited company, also you'd then have tax, which is your corporation tax, and that would then give you a profit after tax, and that's the amount that you can then distribute, either paying out to your shareholders or you can reinvest it into the business. And then balance sheets. So this is a balance sheet. So similar again, you can have a comparison against a different period. You have fixed assets at the top, and then you'd have your current assets, which would be things like money in the bank. If you've got stock, that would also be under current assets, and also money that's owed to you. And then underneath you have the creditors. So this is money that's you need to pay out. It's usually split into either current creditors, where the ones that you owe in the next year, and also long-term creditors, which is generally tends to be loans. So if you've got a loan which is due over several years, then that would be under long-term creditors. And then at the bottom you have the kind of equity or capital. So that's the money that's kind of sitting in the business, and that kind of the total of the that is the value of your business. So the balance sheet is basically what the company owns. It's at a point in time, so where the profit and loss is over a period of time. So the profit and loss, if you were doing a year's worth of accounts, you were maybe doing from 1st of April to 31st of March, the balance sheet would only be as at the 31st of March. So it's a kind of a continuous doing ins and outs of your business, and that's kind of the value as that point in time. So it's useful for determining the financial health of your business. It values the business, so your bottom line figure is kind of what your value of your business is, And again, the same as the profit and loss, it's useful for monitoring change over time. You can compare against previous periods, and you can identify where things are changing. So the balance sheet report is usually shown as assets minus liabilities equals equity, but it can also be shown as assets equals equity minus liabilities. As I said, it's a point in time. But what it doesn't show is obviously it can't capture everything. And what sometimes you'll hear about goodwill. Generally, a set of accounts for definitely for small businesses and for sole traders won't include anything for goodwill. So actually, the value of your business may actually be higher than what you're showing in your balance sheet. So if you have an amazing brand, or if you've got great employees, all those sorts of things which could generate goodwill won't be shown in your generally shown in your balance sheet. So assets and liabilities. So here we've got your assets. So assets are everything that are owned by you. Sorry, I need to take a drink. So everything that's owned by you, so money in the bank, all your any assets, anything that's owed to you, any stock, all those sorts of things go in your assets. Your liabilities will be money that's owed to others, which will usually be your loans. So where you've got loans, if you've taken debt out, then you'll have that. Also, money that you owe to HMRC will generally be in there. If you haven't paid your wages yet, then that kind of money will sit in on liabilities until it's paid. Anything kind of where you're due to pay money out, the balance sheet tends to act as kind of a control account. So where you kind of bills that you're due to pay, they'll sit on the balance sheet until you actually pay them. So it's kind of a way of monitoring what is owed and what is owed to you. And also assets and liabilities can be split down further into current and long term. So current assets would generally be anything that you could sell fairly quickly. So generally most of your assets, everything that's in the bank, and generally money that's owed to you could be paid fairly quickly. The same for the current liabilities, everything that you could have that is due within the next 12 months is a current liability, and anything that's over that. So if you've got a long-term loan, then that would be the liability over a year. And then you have total assets. Sometimes you'll see it split down into total current assets, net assets, and total, and then you've obviously got the long-term ones as well. So you end up with a total assets. And then you've got your share capital, which is the money that's paid in. Obviously, if you're a sole trader, then you won't have a share capital, but you may have money that you've invested into the business. Your retained profit will be anything that you've got left in the business. So if you've made a profit and you've taken money out, whether that's as a sole trader or as a limited company, then what's left will be your retained profit, and that gives you a total equity figure, and that's kind of the value of your business. And that both those figures need to match. So your total assets and your total equity need to match. That's kind of where the trial balance comes in. Whereas everything on one side needs to match the other. So where you've got all your money coming in and money going out, the bottom line needs to match somehow. So some tips on the P&L and balance sheet. Obviously, for small businesses, keep it simple, don't overcomplicate it. Focus on the basics. It doesn't need to be overcomplicated. If you're using software, obviously it makes it easier. They can it automates the calculations for you, but also it generates all the reports for you. But when you go into something like Xero or QuickBooks, there can be loads and loads and loads of different accounts. And actually you don't need to use them, just use what works for you. If you've got a really simple business and you're paying out bank fees, accountants fees, marketing and salaries, then that's all the account codes you need. You don't need to break it down into anything more complicated than that unless you want to. If there's something you want to monitor, then you can use account code for that. So in my accounts, I've got a separate code for networking, which is separate from advertising marketing, because actually I like to know, that's one of my bigger expenses for marketing, and I like to know how much I'm spending on that. Finding account codes that work for you, rather than just what's in a set of accounts. And obviously, if you're using spreadsheets, it makes it a bit more difficult to create those reports, but it's still possible. But keep it simple, don't make it too complicated. And obviously check them regularly, because actually there's no point just having a profit and loss account or a profit and loss state report or a balance sheet if you're not actually going to check it. So yeah. So I'm going to talk about some metrics for small businesses. So these are some of the things that you can be looking at and why. You've probably heard of key performance indicators, KPIs. They're obviously used for all sorts of things, not just for finance, but they used to measure the important aspects in your business. They allow you to track progress towards goals. They can be used for anything that is measurable. So you could be how many employees you've got, or productivity by employee, or all sorts of different things. But what you need to do is make sure that they're relevant, they're balanced. So you need some short and long term, but also understandable, and also need to be shared. So if you've got employees or anybody else that's invested in your business, or has an impact on what you're doing, but sharing those metrics with them will help you all move towards a shared goal. So why use metrics? So analysing your accounts can help you to identify the strengths and weaknesses, helps you identify areas for improvement. It can help you identify trends. So particularly useful if you've got a seasonal business. If you think about maybe an ice cream van, for them knowing kind of when the peaks and troughs are in their year. So obviously summer is going to be a much higher sales period for them, whereas winter is probably quite low. But for them being able to identify when those peaks and troughs are, can help them make decisions, and help them kind of identify where things need to be changed, or whether things they can do to kind of have less of a low, and just helps you make informed decisions in your business, and which obviously can then help you increase your profitability, increases the chance of a long-term success. So going back to kind of the ice cream story, if you had an ice cream van who was hoping that actually he'd be earning the same sort of money throughout the year, and then he's spent all his money when it comes to September, and then realizes actually he's got several months to get through. Actually, if you've identified that before you get there, then it'll help you get through those leaner months, and then be ready for the next year, and taking full advantage of when it's sunny again. I'm hoping. So I'm just I've picked 4 kind of metrics, which I'm just going to show you what they are and how they work. And these are probably the 4 most basic ones that probably most people have heard of. So the first one is gross profit margin, which is a percentage of your turnover. So what we do is we take the gross profit and we divide that by the turnover, and that gives us a percentage. So what that percentage means is that for every £1 of sales revenue that you've generated, you're going to make, I don't know why that says net profit, you're going to make a gross profit of 95p for every pound that you've generated sales turnover. So what this can tell you is that it shows you what proportion of sales income that you're keeping within the business. It shows you how effectively that you, or efficiently, you're producing your goods and services. If you've got a very low margin, that means there's not much left to cover overheads, which is great if you haven't got any overheads. And simply, obviously, if you have a very low, lean business and don't have any overheads. And your ideal margin will actually depend very much on which industry you're in, and all sorts of different things. So if you're a service-based industry, your margin is probably going to be much higher than if you're a product-based industry, obviously, because usually particularly if you're retail, you're going to have to buy all the products in, so actually your margin, it's going to be lower. And also if you're making products, then obviously your margin will be much lower. And then, so the next one is the net profit margin. So this one is taking your bottom figure. So this is after tax, which offers, if you're a sole trader, you won't have the tax in here anyway, so it will be just your net profit. And we divide that by the sales again. And obviously this is going to be lower than your gross profit margin because you had all your overheads taken out. But for this one, the margin is 45%. So for every £1 of sales revenue, then they're making 45p. So then this shows what proportion of sales income is left after you've taken up all your expenses and tax. And that's what the remaining profit that can be distributed to owners or be invested in the business. A low margin doesn't allow much for unexpected costs. So if you've got a very low margin, say 5% or something, actually, if you've got any unexpected costs in there, actually that you're probably not going to be able to absorb them as well as if you've got a much higher margin. But also, if you're a sole trader, because the bottom figure is your wages, you would need a higher net margin than if you're a limited company. And also a limited company where it's a sole director or it's just a couple of directors and they're taking a low salary and a higher dividend, then actually their net margin will be higher than a business where they've got somebody who is managing the business on behalf of an owner. So obviously the margins all vary very much from business to business and industry to industry. This one's the a current ratio, which is another one. This is from usually on the balance sheet, and it's taking the current assets. So those are the ones that can be sold quite easily, and you divide it by your total creditors, your current creditors, and this one gives a total of 2. So what it's saying is for every £1 in liability you've got, so every £1 that you owe, you actually have over £2 worth in assets. So it means that actually you could meet your liabilities 2 times over, which is obviously a good place to be. So it's a liquidity ratio. So how quickly you could pay your debts if you needed to. So measuring kind of the business's ability to pay bills and loans. And also although it does include the assets, which is going to take longer to sell, there is another ratio which is pretty much the same. It doesn't include assets, which is called a quick ratio. It's basically tell you the same thing, but it's because it doesn't include the assets. So basically, what you can cover, bills you can cover from what the money you've got in the bank and the money that's owed to you. A ratio above 1 means that the business can meet those short-term debts and is generally healthy. If it's below 1, then obviously you haven't got enough money in there to cover those debts. So if you needed to pay something off quickly, you may not be able to do it. And obviously it's a snapshot at a moment in time. So like all these metrics, you need to be wary of when if you're comparing it against a previous period, you just need to make sure you're comparing like with like. And the debt to equity ratio. So this one is taking your total creditors and dividing it by your total equity, so your capital. And this one's 0.83. So for every £1 in equity, there is 0.83 of debt. And this is seen as a measure of stability. So obviously debt isn't all bad, and we're all going to have a little bit of debt in our businesses. Some of it will be tax, some of it will just be maybe money owed to ourselves. We may owe money to suppliers, and also a healthy level of debt can help a business grow. So sometimes, particularly if you've got a business where you've got stock, you may need to actually buy stock up front or have some debt up front. A higher ratio suggests there is more debt, but between 1 and 1.5 is seen as good. Smaller businesses or more established businesses where they don't need debt, below 1 would probably be achievable and seen as a good ratio. Obviously, the smaller a business, the more risk there is involved anyway. And actually, if you've got too much debt, the risks are higher, and you probably don't want to be taking on too much debt. It needs to be at a manageable level. So things to consider, obviously, as I mentioned, comparing against past periods, there's no point just taking one of those ratios at one moment in time and not comparing it to previous periods. Actually, it doesn't really mean anything. Comparing it against different industries can help you see how you're competing against other people in your industry. If somebody's making, a 50% net profit margin and you're making 10%, then it can help you identify actually where maybe change is needed. It could be just you've got a completely different way of setup, but it can help you see how things could change. And you can also analyse trends, so identify the trends in your performance, so that can help you make informed decisions. So look at those ratios across a period of time, just see where they change and why they change, and use that information. And then I'm just going to quickly go through making sense of your accounts. So this is so the profit and loss statement, obviously we've been through, but this the report shows your revenue, expenses, and your profit over a specific period, and helps you understand if you're making money. So your P&L shows you're increasing revenue, but has declining profit. Then might be that your expenses are going up higher than what you're anticipating, but it can help you identify those trends and see where things need changing. The balance sheet is a snapshot of your assets, what you own and what you owe, and your equity at a specific point in time. The balance sheet can help you reveal if you have too much money tied up in stock, or if you're taking on too much debt. And we haven't covered the cash flow statement, but obviously when you're looking at the reports, actually the cash flow statement is one of the more important ones. That actually helps you track the movement of cash. You could be making lots of profit, but actually if nobody's paying you, then you're not going to have any cash. So your cash flow statement is also really worth looking at, even if it is taking your bank account and seeing what your cash balance is at the moment, looking forward and identifying what money needs to go out and what's coming in the next say quarter. It can help you identify where problems are coming up, and analysing the data. So comparing your financials over different periods, whether that's quarters, months or years, can help you identify patterns in those. So I've talked about holiday seasons, but also if you've got some businesses, not always obvious when you have got high and lows in your year, but actually if you compare a 12 months month by month profit and loss, or even or balance sheet, and then compare it against the previous period as well for those 12 months, it helps you identify where things look different. So even in a service-based industry, obviously Christmas is always one that most people probably find where their income dips a bit, because actually everybody's decided to shut down on the 1st of December and delay decisions until January. So actually being able to identify those can help you plan your business and plan accordingly. So use those ratios that we talked about. Use simple calculations that can help you assess your business performance. So things like we talked about the gross profit margin, but this shows you how efficiently you're using your goods and services. A declining profit margin could mean that your production costs are rising, or that you're spending too much money on producing a service. The current ratio, which is the one where it's showing your ability to pay your short-term obligations. If your ratio is below 1, that means that you may not be able to pay your bills on time. So monitoring things like that can help. And also your break-even analysis. So calculate the costs, calculate the sales volume that you need to achieve to cover all your costs. So if you've got, so you're going to have, if you've got a shop in particular, you're going to have fixed costs like your rent, rates, utilities, probably staffing costs. Actually, when you know what all those costs add up to, then you can work out how much sales you need to achieve to actually make a profit, and then you can set strategies based on that, whether you need to increase prices or cut your costs. So also you can look at things like your pricing. So if you've got a low profit margin, then you might need to consider whether you adjust your prices or find ways to cut costs. If you have inventory, too much stock, you can consider having a promotion, whether you do a sale, so that you can bring in cash, and also get rid of stock that's hanging around, particularly if it's seasonal. I've got a client that owns a very nice clothes shop in town. Whenever so often, particularly when she's got a VAT bill coming up, she'll do a promotion and send it out to her email list, and then so she creates some cash coming in, but also that means that she's getting rid of moving her stock quicker, and it means that actually she's got space for the new stock coming in, and she doesn't have stock that's left over at the end of the season which she can't move. And then expenses, if your expenses are going up too much, you can identify areas where you can cut back. It can also help you set a budget. So if you can compare against the previous year, if you spent, I don't know, £2,000 on marketing but didn't have anything to show for it, then actually you can maybe plan about where you need to spend that money, what worked and what didn't, and then you can create a budget based on what actually worked and how you're going to do that going forward. And financing, if you need a business loan, or even if you need an overdraft these days, actually having that financial information can be really handy. Banks like to be able to see that information. They like to know that actually you have those documents and you are creating those reports. And forecasting, I mentioned it briefly, but you can use the data to forecast forward. If you're particularly the first time you're creating a forecast or a budget, using past data is a really easy way to create your first forecast, because you've already done it. You kind of know that have that information. You can then use it to identify whether you think your sales are going to increase by X amount, and then what costs will increase in proportion with that, whether some of them are fixed and won't increase, and where you identify where you need to maybe increase your wage bill because you've got to take on staff to manage those expenses, and what kind of all those things, how they impact your bottom line and your profit margin. And you can then use that information to evaluate whether you're looking at new products, and how the impact that could have in your business, and also how you're pricing those and all those types of things. So that was a whistle-stop tour of financial reports. And that's my details. But yeah, if anybody's got any questions or
thank you, Rebecca. Just put your slide back to your contact details just so we can have a look at them again before we sign off on the recording. So there's Rebecca's contact details. I'll definitely book a one-to-one with her just to go through some of those things, because although some of them were really well explained, I've still got a few questions, as probably some of the others in the room have, because it's really an important time. A lot of people do goal setting, intention setting, business plans for the rest of the year, and I just thought forecasting and understanding your numbers today from the previous year is so important, taking your numbers forward. So we're going to stop the recording in a second. Rebecca, thank you so much. Everyone else, stay in the room, because we're going to do our Q&A. So I'd like to say thank you, everybody, for watching on replay. And we're going to carry on without you, I'm afraid. But we'll see you all soon. Thank you.